The TSX dropped. AI-adjacent names dropped with it. And on the surface, that looks like a clean, simple story about risk-off sentiment pulling everything down together. But here's the problem. The companies caught in this sell-off are not experiencing deteriorating fundamentals. The sector-specific growth narratives, the ones that justified their valuations in the first place, are still intact. So the question isn't why markets sold off. The question is why stocks with uncorrelated underlying drivers are moving in lockstep with the index. That is the tension worth sitting with. Tariffs on hardware components are the mechanism most commentary has skipped past. When the US and key trading partners move toward reciprocal tariff structures, the immediate casualties are not software platforms. They are the physical supply chains that underpin AI infrastructure buildout, GPUs, networking equipment, specialized semiconductors, the data center hardware that hyperscalers are racing to deploy. A tariff shock on these components doesn't hit Shopify's merchant transaction volume, but it does reshape the capital expenditure timelines of every major cloud provider, and that secondary effect ripples into the valuation assumptions for everything adjacent to the AI infrastructure trade. Shopify sits in an interesting position here. Piper Sandler reiterated its rating on the stock based on growth outlook. That signal, coming at the end of March, suggests the analyst community is not revising its fundamental thesis on the company. Shopify's exposure to tariff-driven hardware cost inflation is indirect at best. Its merchants face potential input cost pressures, but the platform itself operates on software margins. The sell-off pulling Shopify down with the broader index is, by that logic, a macro correlation trade rather than a fundamental re-rating. That distinction matters more than it might appear. When a stock sells off due to sector contagion rather than company-specific deterioration, the recovery path tends to be faster and more complete, provided the macro overhang lifts. The risk is that the overhang doesn't lift, and contagion becomes the new fundamental. Now, here is the part most of the coverage has missed entirely. Brookfield Business Partners saw short interest rise 24.3% in March. That is not a minor statistical footnote. A move of that magnitude in short positioning tells you that a segment of the market is not just cautious, it is actively expressing a negative directional bet. And at the same time, technical analysis on Brookfield's parent company BN shows resistance at 57.58 with broader trends described as bearish. Two separate data signals from short positioning and from price structure are pointing in the same direction on the same name at the same time.
That kind of convergence doesn't happen randomly. It suggests institutional participants who have done the work and arrived at a similar conclusion about near-term downside probability. What that conclusion is based on, whether it's leverage exposure, asset valuation sensitivity to rising rates, or something specific to the alternative asset management cycle, isn't fully visible from the surface. But the positioning is visible, and it is notable. Here is where the scenario branching becomes important. If tariff escalation continues and hardware supply chains face sustained disruption, the path for AI infrastructure stocks runs through a prolonged compression period. Capital expenditure deferrals by hyperscalers would reduce near-term demand signals. Valuations that were priced for continued acceleration would need to reset lower. In that environment, the short interest building in names like Brookfield starts to look prescient rather than contrarian. But the recovery path is equally real and arguably more structurally supported. AI infrastructure buildout is not a discretionary project. The competitive dynamics between major cloud providers mean that no single player can afford to meaningfully defer capacity expansion without ceding ground. Tariff costs get absorbed, passed through, or routed around through supply chain diversification, processes that are already underway across the semiconductor industry. If tariff policy moderates, even partially, the overhang on these stocks resolves faster than it built up. The asymmetry here leans toward the recovery path, but only if two conditions hold. First, tariff escalation stops short of a full structural decoupling of hardware supply chains, because that scenario has no near-term resolution. Second, the short positioning in names like Brookfield reflects a timing bet rather than a structural thesis about the business. If the shorts are right about the direction but wrong about the catalyst, the squeeze on the way back is proportional to the buildup on the way down. What the current moment actually represents is a stress test on the gap between narrative and price. The AI infrastructure narrative is intact. The prices are not behaving as though it is. One of those is going to have to move toward the other. And which one moves first depends almost entirely on how the tariff situation develops over the next few weeks. The market is not pricing in a smooth resolution. That is the honest read of where things stand.